AIM stocks have taken a bit of a beating recently, and the junior stock exchange fell more than any other market in the UK in October, registering its largest monthly fall in more than a decade. Chris Boxall from portfolio management company Fundamental Asset Management joins us now with his regular look at a portfolio that he created for us here at IG some 2 odd years ago. Chris, over the period it's been really good talking to you about the way in which these portfolios have really gained a lot of traction, but all of a sudden in this last quarter it has been the most dire time.
Absolutely. I mean, we've got this small cap AIM sell-off. We've seen it before and probably will see it again in a few years. That we've had a terrific run generally across small caps, and it's really hits the small cap market, the sell-off over the last few weeks. I mean, AIM was in a quarter to date, I think it's down 18% or so. Look, it isn't alone. The main market, the 100 and the all share has been smashed as well. I think something to bear in mind with AIM, though, we dropped below the 100 billion value. You know, it's been well above that 100 billion value for I think a year and a bit, since I think August 2017 or something, and now we dropped down about 98 billion value for the total value of AIM. When we last spoke, we had, I think, 17 AIM companies of $1 billion or more market cap. That's now there are only 12. Right. Now, so there are still a lot of positives, so some great businesses on AIM. But when you have a sell-off, small caps get really hit, and it's sort of self-perpetuating. Everybody and you start selling, and at times like these, the best thing to do often is to do absolutely nothing. Just
batten down the hatches.
And just sit and watch and wait. And if you've got cash on the side, you should be rubbing your hands, because this opportunity we've been waiting for a while. You should be really enthusiastic, looking at those companies you know about, ready to jump. You're never going to get it right. It's very hard to time things, but there is going to be some good little opportunities out there.
But the nice thing about a portfolio is you get a nice spread, don't you? And you can really play the market well. You can
have some big losers. You can have some great winners as well.
Well, let's take a look first of all at your standard portfolio that it has changed over the last couple of years. A couple of stocks come in, a couple have gone for whatever reason. Broadly speaking, those that have seen these interviews before will know this list. What do you want to talk about today?
Well, first we've got a few positives still, and we've had some big negatives, and we're sticking with some of our negatives because we think they're in a good place to recover, and we haven't seen any news that is awful to suggest that we should sell. Obviously perhaps we were mentioning briefly Patisserie Holdings. We've got it in there. It's been the out-and-out outperformer from the quarter because the shares are suspended. Who knows what the price will be when they come off suspension? It's taking a very long time, and our fears are that, you know, there are some clearly very nasty issues that they've got to clear up, and we're worried about the legal process and how much of that is going to consume of what's left of this business. But you know, it's there. It's at the suspended price, which is about 430p. Who knows when we'll see the shares trading again? But you know, maybe on to more positive stories. Yes,
let's take AB Dynamics as the top one there. It is up what, 44%. And if we look at the chart, actually, the chart itself says a lot. And this is the daily chart. And you don't really see much of what we saw in October as that dire month for the index overall. AB Dynamics seems to have weathered it more than better.
They announced terrific results in the last few weeks, or last month or so. You know, revenue sort of up 50+%. Operating profit was up 40-odd%. They got a great order book. They're a developer of testing systems for the automotive sector. Lovely business. We've followed them ever since IPO. This business IPO'd at a market cap of about 14 million. It's now 280 odd. Its chairman at the time was 75. I think 75 years of age when they IPO'd. He's still there. Came back, I think, as exec chairman. He stepped back down again.
Still with a big interest in the stock?
Still 30-odd% interested. Now, that's a good point, though. He has sold down quite a lot. He's 30% still significant. He sold down quite a lot. And another member of the senior management team in the operating company level also sold out quite a bit. You can't blame them, you know, looking at the share price chart. But it always worries us a little bit. But this is a lovely business in a very dynamic sector. It's very active, loads of investment going on. They supply all the major motor manufacturers. They're developing new products. They've got some great partnerships. It's a case of, you know, the valuation looks quite punchy at about 30-odd times forecast earnings. They've got cash in the bank. They've got a new facility. So I think it's one ignore valuation, look at how they're operating, look at the quality of it. And quality shone through in this business from the very start. So we're happy to stick with it, despite what looks like a punchy valuation in the current marketplace.
Let's take a look at your second stock, and this is Bioventix on this list, taking 28.9% up. And the chart, similarly, it's really weathered what has been an AIM storm quite well.
Absolutely. Again, positive announcement recently. They distribute all their spare cash as dividend. This business develops monoclonal antibodies for use in testing, blood testing, things like thyroid cancer. It's a very small business. It's an IP business. It makes vast margins, revenue sort of 8-9 million, and it's making 70-80% margins from those. So it's very much about its IP. It's only got about, I think they employed 12 people. Tiny business, 160 million market capitalization, lovely little AIM business. It's very, it is to a certain extent dependent now on the growth of its vitamin D assay, antibody rollout, and again, one to stick with. It offers, it's yielding circa 3% and a bit, a lot of special dividends out of excess surplus cash. So one we would stick with again. Valuation looks quite punchy in isolation, but those high margins, high returns on capital, just what people should be looking for, a quality business again.
Another stock I know you want to talk about is Character Group, and as we said before we went to air, it's a good stock to talk about at this time of year because they have a lot of toys which children relate well to TV and film.
Absolutely, yeah. I mean, Character Group's a toy company. As the graph shows, the share price hasn't really gone anywhere, but over a period, although they have recovered quite strongly. Recent results were quite positive. I mean, it was the forecast decline in top-line revenue, forecast fall in profits. They got sucked into the Toys R Us failure a little bit, but they've got some. They're very reliant on one key franchise, one key license, which is Peppa Pig, which they've held for a long time, and Peppa Pig is super successful around the world. Net cash position, despite the decline in profitability and the marginal decline in profitability and top line, they up their dividend quite materially because they've got this nice cash buffer. They've got some hidden real estate assets as well that offer a little bit more comfort. The disappointment with this one has been that the top line hasn't really moved over many years, not materially. And from my perspective, I'm somewhat uncomfortable with the level of directors' remuneration out of this company. They pay very, very high relative to real returns or outperformance, which there hasn't been. Management, ironically, management are huge shareholders as well. Right. They could probably lift the divvy even more and benefit. So there's a bit of it, in my opinion, there's a bit of a misalignment there, a bit of mistrust as a result, which will probably continue to be a drag on the share price. I think they really have to address the directors' remuneration, which it's only a small company, 100-odd million market capitalisation.
I know one also want to talk about on the standard portfolio is Fulcrum Utility Services. Now this is on the left-hand side. You can see they're down 18% or so. Why pick this one out particularly? Well,
they announced recently pretty good results, and like-for-like revenue was up about 12%. Overall revenue was up about 40-odd. The original business was provider and installer of infrastructure, notably gas pipelines into both commercial and residential, and they've adopted a policy of owning the assets. So they're not only installing and specifying them, they're actually then owning the pipeline assets, which generates a nice recurring revenue. Nice cash generation as well. They get a lot of money up front with orders, so cash flow is good. They made a big purchase of a business in the electrical installation area, typically with contracts style much larger than theirs, so the contracts are a little bit lumpier. Recent results were good, but they alluded to the fact that the business they acquired, there'd been a bit of delay in contracts coming through because they're of a larger nature. But I think the disquiet on this stock that's probably affected the share price and investors' perception of it was the fact that just after raising quite a lot of money, 10-odd million, to support the purchase of what the business called Dunamis, only a few months later, management exercised a vast number of options and sold out to the tune of several million. Now, that's pretty rich. You take from one.
Ring alarm bells for you, is it?
Well, it's just a bit. not the thing to do, is it really? I mean, you raise a load of money from outside shareholders, and then you cash out at a similar level. And I think there's a little bit of distrust around that as a result. But quite a nice business.
Let's move on to your high yield portfolio if you can. Again, you put this together for us a little bit more recently than the standard one. But on here, I want to pull out particularly Shoe Zone, which is up 10.8% year to date.
I think this is a truly fantastic story for this year, and that's why I want to draw attention to it. Shoe Zone is a retailer, pretty awful sector of value shoes. And look, its share price hasn't gone really anywhere. However, it's kept its head above water, and it's delivered some mighty dividends to shareholders. It's also reformatted its offering a bit. It's growing online, and it is moving into what's called its big box format. So it's moving off the high street into bigger units. And I think this is a truly, epic performance in what is a diabolical sector.
And it's paying 6% dividend.
Absolutely. So, hats off to them. And they've got cash in the bank. They've upped the divvy. Really, really unexpected, and well done. Well done.
Let's move on to Jarvis Securities. What does Jarvis do?
Well, they're stockbrokers and providers of administrative and broking services to other institutional investors. Our firm actually uses them for our portfolios, and we think that they've upped their divvy recently. They provide a quarterly dividend. The yield circa 5%. They should be a good, very high margins, very high returns on equity. Insiders own 50-odd% of it, the senior management team, principally one gentleman, and we think they should be doing quite well in the current high volatility environment, and also there will be a beneficiary of rising interest rates. So more and more people trade. They only make money when people trade, and we know as well they had a early hiccup earlier this year, following MiFID, with increased costs. We know to our costs they passed on a lot of this increased cost to their clients, and so we think they should be doing pretty well. Would
you buy it 472? I would.
Yeah. I'm a regular buyer. I think it's a very neat, simple, well-run business, lots of reliable recurring revenue, and decent returns.
Next one, Zytronic.
Zytronic, just announced today. This is a manufacturer based in just outside Newcastle of touchscreens. The application, they go into gaming machines, ATMs, so things your hands touch. Really robust touchscreens with their unique patented technology. They've announced today revenues were down a bit. The stock struggled because, having reported 4 years of uninterrupted top-line growth, they've stuttered a bit this year. This business has very little visibility. However, its yield is quite high. It's got net cash, and now it's divvying out a lot of its surplus cash. So you're getting a very high yield on it. Free cash flow is very good. I mean, free cash flow yield is about 7% of this stock now. So you're getting a dividend yield about 5%. Free cash flow of having just reported. Our issue with this business, lovely little business. We're a bit frustrated. It's never made enough of its stock market listing. It's never acquired anything, not to my knowledge. I'm not saying it should do, but it's got this listing. It's costing it money. It effectively remains a private company, and it's promised a lot for a long time. But hopefully nothing to go wrong.
You're going to keep it in the portfolio?
For now, we'll keep it. But it's on watch, shall we say? It's 59-odd million market cap. I'd love it to perform. I've got a soft spot for it. It's very clean balance sheet. It's just it's under-delivered in relative terms.
Yeah, your final one is doorstep lender Morses Club.
Yeah, about 170, 180 million market cap. Very much a yield.
Nice little yield, 5.75%.
Yeah, very much a yield play. The slight concern was, if you look at the cash flow of this one historically, and the cash flow profiles changed, and they haven't provided, to my mind, a really good explanation why. But previously, the operating cash flow didn't cover the dividend. Most recent results, it was covering the payout. Very big dividend payout. They operate through a number of commissioned agents who go along collecting debts. The big thing to look at on this is impairments, if people basically default and don't pay. So you've got to keep a close eye on the impairments on this. In the meantime, enjoy the dividend. It's never second. I think it's UK's second largest. The growth is probably questionable. Where's it going to go from here? So very much a yield play for now, at least.
And you buy at 135?
Yeah, I buy. I mean, look at this. I mean, I buy around these levels. A lot of these high yielders, if the balance sheets are reasonably robust, let's say the cash flow, I'm a bit unsettled with this one a little bit. Yeah. But if you've got comfort on balance sheet, you've got comfort the cash is coming through, they're effectively yield plays, and you can expect a dividend, a steady or marginally growing dividend over the next few years. Stick with it. Yeah.
Good. Okay. All right, Chris. Thanks indeed for running through those, and Happy New Year to you and to your clients as well at Fundamental Asset Management. Chris Boxall joining us there from the portfolio management company Fundamental Asset Management.